So if each of you can provide some color, what political configuration in DC mean for your portfolio?
So we're not changing one thing regardless of who wins. You know, I think the market does a very good job of trying to suss out the politics versus what policies will directly affect economic activity and earnings. And when you break it down, just by the math, it's obviously taxes, because that flows through to what we keep and what we spend and what flows through an income statement. And then, of course, the regulatory side. Now, on the tax side, now Trump in 2016 had the benefit of taxes to cut. You know, there was low-hanging fruit on the corporate side, and obviously he did what he did on the personal income side with other things. So the corporate income tax rate is unlikely to change. So at best, it stays the same. On the income tax side, we know his tax cuts expire at the end of 2025, and obviously depending on the makeup of Congress and wherever, to what extent will they get extended? But even if Kamala wins, the state of the economy could determine whether she wants to extend them or not. Because we have to remember that Obama in 2009 extended almost all of the Bush tax cuts because we were coming out of a recession. On the regulatory side, I am just sort of debating in my head that when the Supreme Court overturned that Chevron case, did that mean that the executive branch was going to be less influential in terms of running the regulatory state? And is it going to be more in the hands of Congress to write detailed laws that's not up for agency interpretation, and will be up to the judges to decide the legacy regulatory structure that many businesses are going to sue over, of course? And that maybe we're going to have new heads of the different agencies if Trump wins. Maybe they'll be, again, more or less influential because of that case. We'll have to see. I guess my bottom line is we are not changing one thing. You know, we're long energy stocks, so people ask, well, are you going to change if Trump wins and drill, drill, drill? But we're not, because everyone's drilling what they want on private lands. This is just opening up some public lands. I don't think that's really going to be a needle mover anyway. So we're not changing a thing now. We have to be cognizant of what's going to happen and who's going to take control of Congress and what comes our way. But at least initially, I don't find the need to really make any changes.
Thanks, Peter. Thanks a lot. Stas, from 10-year Treasury bond perspective, Republicans, Democrats?
Well, I think it comes down to the policies that they're able to enact following the election and the implication on the inflation, because really it's more than a 10-year, it's about the bond stock correlation and really what's driving the movements in those markets, whether it's the worry about inflation, which means that they're positive and you don't have the diversification from treasuries, or it's negative where you have worry about the economy and you actually have the flight to safety, and you know, to what extent that safety is defined. And I think we've seen some pretty big swings in that regard, where post-COVID pandemic, the correlation was positive, and we only had few of those moments before, like during the taper tantrum and a few others, but most of this century, we actually enjoyed the negative correlation, the hedging effect of the treasuries. And I think depending on what happens with inflation, it may or may not continue. So I think, to me, that's the key point to watch here and how it impacts the multi-asset portfolios.
Thanks, Stas. And in terms of asset allocation, Jason, please go ahead.
So I'd pick up on Stas's comment about the relationship between stocks and bonds. For 20 years, it was kind of a perfect, like bonds, treasury bonds were sort of a perfect asset class from about 2002 up until like essentially like January 3rd of 2022, if you like had a bond portfolio at that time, because they had a negative correlation with stocks. So if stocks sold off, bonds rallied, so that diversified your portfolio. They had a good return because starting yields back in 2000 were around 6%, and they had relatively low volatility. So today, starting yields a little bit lower, but still not bad, all things considered, compared to where we were. Volatility still and should be relatively contained, but this correlation, I think that's probably not going to go back to what it was before. And in simple terms, I think in an environment where the markets are more worried about growth, and for like the 2010s, at least, you were more worried about slipping into recession, the correlation tends to be negative. When you're more worried about inflation, and I think that's going to be the risk going forward, that inflation can be contained, but the risks are always skewed to like a little inflation shocks. That correlation is not going to be as negative, and maybe positive. So from portfolio construction and asset allocation, then you have to think about, well, if bonds aren't going to diversify my portfolio, I have to think about other asset classes. And so like, privates are, I think, kind of front and center, whether it's, hedge fund strategies, private equity, private credit, infrastructure, real assets that could, again, provide some return there. So that's definitely one thing that we think about, like how do you add and diversify. The second thing, and this actually kind of picks up on a point, Vidak, you mentioned earlier on, like the number of zombie companies. And I think of like, particularly small caps, you hear these statistics out of the Russell 2000 index, is it 30 or 40% don't make any money? Now, the small cap sector overall, I think, has changed a lot in 25, 30 years. The number of public companies in the US was over 8,000 back in 1995, 96. Now it's less than 4,000. And a big part of that is like private equity is kind of taken up a lot. Companies that might have gone public, they're going through the private route. It does kind of raise the question to me, like, if private equities looked at the Russell 2000 and bought all the good stuff, and if I want to buy it as a public investor, like, am I getting kind of an adverse, like the Lemons problem? Which does mean that, and we look at like, well, now you almost have no choice but as an asset allocator to look to private markets because there are opportunities there that weren't there 10 years ago, certainly 20 or 30 years ago. So thinking about portfolio diversification and thinking about your opportunity set, that is, I think, sort of fundamentally changed versus, even just 5 years ago.
Great, thank you, Jason. And Mina, from private markets, private equity point of view, what does it represent for you in terms of DC configuration?
Right. So I think, hearing what we just heard, everybody was focused on growth. Everybody wanted growth, the growth, and we know in the S&P right now is 5 growth companies which are doing well. So now I am beginning to look more at, not necessarily growth. The companies, you don't think about industrial services, you don't think about transportation. They're all benefiting from the trends that we're talking about. A lot of capital spending in energy space, a lot of capital spending everywhere. The different acts that are supporting it, infrastructure bill that's supporting it. So maybe one should look into industrial services, and it doesn't have to be very large companies. It could be small companies. For instance, I'm looking at maybe 5 or 10 different opportunities where the funds are giving 20, 30% returns, but they're not necessarily very large funds. They're small funds focused on Main Street America, which are benefiting from a lot of CapEx spending that is happening. So I'm looking at that. On the real estate side, I know that construction lending has been, banks are not lending because everybody has been risk averse because of all that's going on. And nobody's sure about what's going to happen in the rates market. The data is not equating with what you're seeing in the real economy. Construction lending, which is considered to be more opportunistic, more risky, nobody's lending, very little lending and very little new construction. But we know that people need housing, people need, e-commerce is growing, so you need industrial space, and there's certain demographics or certain regions that are doing very well. So I'm looking into exploring where construction lending could be made, and they could give you uncorrelated returns.